Okay. So I'm trying to mess with some new technology here, linking my iPad and the slideshow and stuff. So if everything shorts out and just blows up, I apologize in advance. Last I checked, a number of you hadn't done the quiz for last week yet. Did everyone get that, or did people forget about it? I'm not looking at anyone in particular, but I know it's a couple of people next to each other that I've forgotten. Jeez. No, I didn't check after the deadline had passed. The last I'd seen, some people had forgotten to take it. So anyway. Did I send out an email about just having them all online and not coming in on Thursdays? No? I sent it to a couple of people that specifically said they were going to miss on Thursday, and I couldn't remember if I sent to everyone. But I think I'm going to have you guys not come in on Thursdays, unless you were one of the people that didn't like that, and then I'll proctor your exam personally. If you want. I don't know. I don't get to see who said what on the. I just see the comments. I don't see who said them. So might have been someone that doesn't have the class this semester. So I don't know. But if you're that person, I'm more than willing to have you come take it in my office, or I'll come in here, or whatever. For everyone else, it'll just be online this Thursday. And last semester, I think I had to do the next class day, so that might be why you guys didn't remember to get it. This past week it was due Sunday night.
Okay, so we're not gonna. It's not like at a specific time on Thursday, or.
No, it'll just be open on Thursday, and I might open it before then, but it'll be open for sure by Thursday, and then you'll have until Sunday night to take it. Okay, so that'll be week in, week out. So if you need to set an alarm or whatever to remind you Sunday afternoon, feel free to do that.
All right, if I was to set that alarm, what time would?
So 11:59 is when it closes.
Yeah, I got it. There's nothing.
But I think you just have to be logged in by 11:59. So if you're a night owl, just make sure you open it by that time. Okay. Anybody has any other issues or concerns or questions before we start this week's stuff? Nothing? Okay. This week we're talking about the corporate income tax. Okay. Obviously that's what this whole class is about, but specifically the components that go into it, the corporate tax equation, some of the more common deductions or maybe slightly more complicated deductions. So we'll start by talking, I'm going to keep looking behind me just so I know for sure that it's showing what I want it to show. But we're going to start by talking about corporate tax year, right? So as individuals, we pretty much always are going to be using the calendar year, January to December. The corporations don't have that same requirement. You are required to use the same calendar or fiscal year that you do with your financial reporting, which is, sometimes your financial reporting and what you do for taxes are going to be totally different. So this is one of the occasions where they need to be the same. And those are a couple of the stipulations there on when it has to occur. Tax year always has to end on the last day of the month. You can't have like the 15th of October to the 14th of the next October. That doesn't work. But as long as the new year starts on the first of one month and that year ends on the last day of the preceding month for the next year, then that could be an acceptable fiscal year. Now, when you start a corporation or when you're organizing a corporation, just because you start business on, say, March 15th of one year, doesn't mean you have to use March as your beginning and end month. So you can set your fiscal year for whatever it needs to be or whatever is best for you based on your business. And so if I set my fiscal year to start July 1st and end June 30th of the next year, but my business started in like May, then I'm just going to have one really short corporate tax year, and then my normal years will begin July 1st of that next year. So if whatever year you start business in is not a full business year, you're still filing normal tax return for that year. It's just a shortened tax return. Okay. other important thing to remember about that is once you've set your fiscal year, it's pretty difficult to change it. So the IRS pretty much keeps you to whatever you set. Can anyone think of any reason why a corporation would want to have a tax year that ends at a different time than the calendar year?
Maybe business is seasonal, so that better coincide with cash flow.
Yeah, so that's the biggest reason is if you look at, for instance, like retail businesses, any big time retail store, Walmart, Target, anything that's greatly affected by the Christmas season in our country, you definitely don't want to have to be doing end-of-year book closing, counting inventory right a few days after Christmas, right? Because that's the busiest time of the year. From Black Friday, the day after Thanksgiving, through like January 2nd or 3rd or whatever, accounts for retail businesses, can be like 60% of sales just in that time period. So obviously counting inventory, doing financial statements, the extra work that goes along with closing a business year, you don't want that to happen right when your busiest time of the year is. So a business like that, or a business like that's completely seasonal, like maybe a ski resort, you're not going to want to close your year if the ski season starts like at the end of November. You're not going to want to close your business year in December when you only have November through March as the only time that you're actually doing the operation. It makes a lot more sense to say, okay, we don't do anything from March until the next November, so let's pick a fiscal year that ends sometime in that period. That way, we can basically have all the closing prep work done, and we can have like several months to do that we're not doing anything else. So it does make sense to have a different year other than the calendar year. Now, why do you think the IRS won't let you switch up your year like every couple of years? Or why would you want to? Why would any business want to say, well, I'm going to have my fiscal year be ending June 30th this year. Next year I'm going to end it October 30th, and then I'm going to change back. Is there any tax or business reason why anyone would want to do that? What do you guys think? If you're trying to outsmart the tax system, why would you ever want to change the end of your fiscal year? Yeah. So, if you know that you're going to get a whole lot or much less income right at the end of your fiscal year this year, and you want to defer that income to the next year, and you were able to change the end or the beginning of your fiscal year, then you can successfully manipulate and kind of defer recognizing revenue or paying taxes on the revenue that you earned, almost a whole year if you're switching right around some big earnings event in your business. So obviously, if you're a big company, you're talking about millions and millions of dollars earned at that time, switching it and deferring that tax for even 10 months, if you look at that from the standpoint of time value of money, that could be a substantial amount of money that you could earn through investing what the money you'd pay for taxes, or for some other business purpose like growing the company or something. So the IRS has incentive because they don't want to lose any money to make sure that you keep the same tax year to year. But then there's also the financial accounting reasons that you wouldn't want to mess with that because, obviously anyone who's looking at your financial statements wants to be able to compare year to year how you've done so they can see what kind of the trends are. Now, if you mess with the tax year, and so the tax expense on your income statement varies from one year to the other and doesn't really accurately show year to year what your changes are, then it's hard for people, investors, or whoever's looking at your financial statements to kind of compare apples to apples there. So there's a lot of reasons why. So once you pick your tax year, you're stuck with it for a minimum of 4 years. And then after that, if you want to change it, you have to have some legitimate business reason to change it. So some legitimate business reasons would be like if, for instance, take the ski resort example. If you're a ski resort and you used to not do anything in the summer, but now you've opened the resort to having summer activities as well, Maybe it makes sense now instead of doing it middle of the summer close of business to changing it to like the beginning of spring or the beginning of fall or some other time that better coincides with kind of the downtime in your year. Let's see. So I'm not going to spend a lot of time on the next couple of slides, but this is just kind of a overview walkthrough of what the steps are in calculating tax liability as far as corporate income tax goes. You start with gross income, subtract deductions and losses. That arrives at taxable income before special deductions. Then you take out special deductions, and we'll talk about all these. That leaves you a taxable income. Multiply taxable income by whatever your corporate tax rate is. That gives you regular tax before credits and other taxes. Subtract any foreign tax credit and possessions tax credit. That leaves you at regular tax. Subtract other tax credits. Add recapture previously claimed tax credits. And that leaves you at regular income tax liability. Then we have taxable income before net operating loss deduction. So these are a lot of the area we're going to spend a lot of time on today is the net operating loss deduction. We won't spend a lot of time on alternative minimum tax today, but we'll talk about that later in the semester. Let's see what else we have here. I'm not going to talk too much about. Does anyone know what the accumulated earnings tax is? Anybody ever heard that before? I don't know if it talks about it in the chapter very much. Anyone who read the chapter remember if it said anything about that? Accumulated earnings tax is basically if a corporation decided for whatever reason that it was in their best interest to kind of sit on corporate earnings and not distribute them as dividends to the shareholders, and not because they want to just reinvest in the company, but they just want to kind of stockpile it in the corporate coffers to avoid paying taxes on that for a while. The IRS basically will swoop in and say, look, if you have above this threshold amount of money that's cash that's just sitting in your corporate bank accounts, and you're not doing anything with it, you're just kind of holding on to it, we are going to penalize you because we think you're just trying to avoid the tax liability that would be incurred if you distributed that out in dividends. But the rest of that, the rest of those slides there, we'll talk about more. This one especially today, alternative minimum tax will be later on in the semester. And we'll spend a little bit of time on some of these other ones. We might spend some more time on the specifics of the accumulated earnings tax later on, depending on how far we get in the semester. Same with personal holding company tax. But anyway, you work your way through this entire list, and finally you get to your tax liability, and you subtract out any estimated payments that you've made for the year, and that determines whether you have tax that you still owe or whether you get a refund back, similar to that portion at least, similar to what happens with individual income tax. As far as alternative minimum tax goes, it functions very similarly to the way that it does for individuals, in that you calculate your regular taxable liability first, and then you calculate the alternative minimum tax, and kind of the difference between those two is the actual alternative minimum tax. And similar to individuals, as a tax professional, if you are calculating corporate income taxes as part of your job, for the first little while, you'll basically calculate alternative minimum tax for every single tax return that you do. Then after a while, once you see what the triggers are for alternative minimum tax, you'll be able to eyeball it better, and you really only calculate that for corporations that you know are going to be subject to that. Let's see. This slide really is just a good resource to look at in terms of where you find the specifics of. So here, if you want to know about the foreign tax credit, you know to go there. General business credits, go there. Minimum tax credits, go there. That's really the only purpose of having that slide in there. Okay, so for corporations, capital gains are taxed at the regular corporate tax rate. Okay, this is a pretty big difference between corporations and individuals. So for individuals, the government has decided that they're going to incentivize people to invest in things by making the effective tax rate on capital gains much less, and even zero sometimes, than it is for your regular individual income tax. Okay? For corporations, they don't feel like the government doesn't feel like it needs to provide that incentive. I think the main reason there is because what's the purpose of a corporation? Make money, right? So if you're in something in the business of making money, I think the government feels like you're already properly incentivized as far as making investment, reinvesting in the company, trying to grow your company, and the incentive behind that is just profit. And as a corporation, you have shareholders that you are having to report to and boards of directors that ensure that you're doing your best to try to make profit. So I think that's the main reason why you don't see that incentive there. But what the thing is even though you don't have to calculate a separate tax rate, so any capital gains that you have, you just add to your ordinary income and apply the corporate tax rate to that. Okay? But that doesn't mean that you don't have to keep track of capital gains separate than your ordinary income. And the reason behind that is because even if you are taxing it at the same rate, you still have some of the same requirements as far as using capital losses to offset capital gains. So if you remember from individual income tax, capital losses generally could only offset capital gains. You had a little leeway where you could offset $3,000 worth of ordinary income with capital losses, but everything else could only be used to offset capital gains. Well, for corporations, you don't get any leeway. All capital losses can only be used to offset capital gains. So you can carry that back 3 years and forward 5 years if you need to, because you can't, for whatever reason this year you had capital gains instead of capital losses as your net. You carry that back 3 years and carry it forward 5 years, and then it just goes away. Okay? So that's why you still have to keep track of capital gains and capital losses so that you can net those two together. But as far as tax consequences of that, you just treat it like ordinary income. Okay? Let's see. So can anyone describe, anyone that's read the chapter or just has knowledge, what are the recapture statutes talking about? What are you recapturing? Like it says there at the bottom, Section 291 recapture rules may cause some or all of the gain to be ordinary. What's recapture talking about? Anybody know? So basically, this is talking about depreciable property, and what you're recapturing is accelerated depreciation. So the tax code stipulates certain situations for certain kinds of property where instead of depreciating it, for instance, over a straight line time period, you may be able to depreciate it at an accelerated rate. Okay? If you elect to take advantage of that, or even if you're forced to accelerate it at a speeded up rate, once you get rid of that property, you may have to go back in and recover. That's what the recapture means. It's you're going back in and you're basically looking at any property that you sold that fits into these categories, and you're going to recalculate depreciation on that property using straight line. Okay? And up to the point where you sell that property and get rid of it. if the straight line depreciation on that property is less than the depreciation that you took from some accelerated method, then the difference between those two is what we call recapture. So the year that you sell the item, that money is treated as if you earned ordinary income for that amount, anytime the recapture statutes come into play. Another difference here is you don't have the option of, oh, I want to carry this back and offset prior year taxes, or I want to just sit on it and use it to offset future taxes. Okay? You have to basically take any capital loss that you have and put it back 3 years. If you can't use it this year, you push it back 3 years and you use it the earliest that you possibly can. Okay? You don't have the option of saying, well, 2 years ago I had a capital gain that I could use this on, but I don't want to use it for that. I want to wait because I think I'll have a higher tax rate next year with the capital gain, and it's going to make more sense for me to use it next year. You don't get that option. Okay? If you can't use it this year, you push it back as far as you can, and you work forward until you can use it. And at that point, you have to use it. Okay, so these are just some various sections that talk about some of the treatment of some expenses for businesses. So Section 162 is the section that just sets out how you treat ordinary business expenses. Okay, so there's a lot of definitions in that section that will be talked about. I'm not going to go into those specifically here because these are just your ordinary business expenses that you would normally think of. Okay. Your chapter in your book this week talks a little bit about startup expenses, which are covered in Section 195, and organizational expenditures. Okay. Can anyone tell me the difference, or does anyone remember the difference between startup expenses and organizational expenditures? It can be a little bit confusing, so if you don't know, I don't really necessarily blame you. Nobody wants to take a stab at it? So startup expenses are basically just ordinary business expenses. Okay? The only reason we call them startup expenses is because you haven't started business operations yet. Okay? So like you would consider payment of salaries an ordinary business expense. Like rent or mortgage on your warehouse, ordinary business expense. Okay? So any of those things that normally occur during normal business operations are ordinary business expenses. We call them startup expenses anytime you incur them before the first day of full business operations, where you're officially in business. Okay? Organizational expenditures are different in nature than startup expenses because these are not your ordinary day-to-day business expenses, and you only have these types of expenses when you're organizing the company. So this would be like legal fees for setting up a corporation, accounting fees for getting things started, anything that you do that is required in order for you to start the business from an organizational standpoint. But then once you do that, it's over with, right? You don't come back 5 years down the road and pay an attorney to organize your corporation again because you already organized it, right? So that's the difference between startup and organizational expenses. They group these two together for obvious reasons. First, in both situations, we're talking about expenses that occur before you start business operations. You also account for tax purposes for these two types of expenses virtually in the same way. So for both of these, and you do keep track of them separately, but for both of these, you are allowed up to $5,000 worth of expenses that you can deduct right now, immediately, for startup expenses, and then another $5,000 that you can immediately deduct for organizational expenses. Okay, there's a threshold limit on both of those of $50,000. So once you hit $50,001 of startup expenses, every dollar thereafter takes away one of the $5,000 that you can immediately expense. So once you hit $55,000, you can't immediately expense anything. Every dollar above and beyond $50,000 is a dollar for dollar reduction of the amount that you can expense immediately. Okay? Everything that you can't expense immediately for both of these categories has to be amortized over a 15-year period, 180 months. Okay? So, obviously, your ordinary business expenses, you expense, as incurred or accrue them as necessary, right? So even though these startup expenses are the exact same types of those expenses, you treat them differently just because you're at a different phase in the corporation's life. Let's see here. Anybody have any questions on the difference between those two? Let's talk a little bit about charitable contributions. And I'm going to basically go through, if you read your chapter, you know that your chapter spends a lot of time on basically 4 or 5 different kind of big categories of deductions that a corporation can take. Some of these are similar to, for instance, charitable contributions, similar to a deduction you can take as an individual, obviously, but there are different stipulations here. So for corporations, the charitable deduction is limited to 10% of the adjusted taxable income. And if you refer back to the chart that we had on there, and I'm pretty sure it shows it in that chart, but if not, corporations' taxable, adjusted taxable income is their taxable income without including whatever the charitable contribution deduction is, net operating loss, capital loss carryback, dividends received deduction, and U.S. production activities deduction. Okay? So basically, of these kind of broad categories of deductions that we're going to talk about today, the first one that you calculate is charitable contributions. Okay? So this is after some, other generic deductions are taken, but before you take account for net operating loss, capital loss carryback, dividends received, and U.S. productions activity deductions. Okay? Some stipulations for charitable contribution. Like I said, for corporations, you're limited to 10% of that adjusted taxable income. Anybody remember what the charitable contribution limitation is for individuals? It's a percentage. I'll give you a hint. It's 50%. So obviously, you're still limited, but 10% is definitely a lot less than 50%, obviously. Okay. Let's see. One thing that's kind of stupid, at least in my opinion, is this stipulation that you have to have charitable intent for a charitable contribution to be considered legit. Okay. I'll tell you right now that at least half of the corporations that give a charitable contribution do it solely to deduct it from their taxes. They don't care at all about giving to whatever charity. Some of them do. There are some corporations that have a soul. But most corporations are, you hear all the time about corporate greed. Most corporations care only about their bottom line. So to suggest that every single one of those that are actually qualifying for the charitable contribution are doing it out of the goodness of their heart is pretty much fantasy. Okay? But the issue there is there's really no way to prove what your charitable intent is with a donation. So why that's in the statute, I have no idea. When you contribute something other than cash, the general rule is that you are granted a deduction equal to the fair market value of the property that you're donating. Okay? Obviously, that is still subject to the 10% threshold that we talked about. Okay? So just because you're giving property instead of cash doesn't mean that now all of a sudden you can deduct 50% of your adjusted taxable income. Still limited to that 10%. But in general, it doesn't matter what your basis is in the property, it just matters what the fair market value is. Some exceptions to that are ordinary income property and capital gain property. Okay? So for ordinary income property, This would be inventory or investment property held for less than 1 year, and any property that's subject to depreciation recapture. For that type of property, the fair market value is still the starting point for what the deduction is, but you're going to take out any short-term capital gain or ordinary income that you would recognize if instead of donating the property, you sold it to at like a third-party arm's-length transaction where you're just trying to get the most out of it that you can. Okay, so that basically means that you're bumping it back down to what your adjusted basis is in the property. Because obviously, if your adjusted basis is $5,000, the fair market value is $10,000, then the income or gain that you recognize on that is $5,000. If you take that back off of the deduction, it brings it back down to what your basis was. Okay. And again, that's for any type of inventory, investment property that's kind of short-term and you've had for less than a year, or anything that has that was subject to the property depreciation recapture. There are some inventory valuation exceptions. Okay, if the donation of your inventory is being used to care for the ill, needy, or infants, if it's not transferred to charity in exchange for basically anything, money, property, services, and if you receive a statement from the charity, then you're allowed, instead of just using your basis in that inventory, you're allowed to deduct half of what the markup would have been. So for instance, if I am in the business of like a restaurant business, okay, my inventory is food, right? So I donate $10,000, fair market value, $10,000 worth of food from my restaurant to a homeless shelter for the purpose of feeding the needy people there. Okay, that food has that inventory has a basis to me of $2,000. Okay, so there's an $8,000 markup there if I were to sell it in my restaurant. What this is saying is basically you can take the difference between your basis and the fair market value, and you can use 50% of that to increase the deduction that would be to you. What they're basically doing there is, again, the IRS is using this deduction as a way to incentivize corporations to give to worthy causes, needy, ill, infants, causes that the IRS or the government, for whatever reason, have deemed needy. However, there is one slight limit to what that can be. If you go back to the example I just said, where I had a $2,000 basis, the fair market value was $10,000. If I just use the 50% markup calculation, then I would be marking that up to $6,000. Okay? But you're limited in your markup to 100% of what your basis is. So in that case, my basis is $2,000. I'm limited in marking that up to a total of $4,000. Even though 50% of my normal markup would have me up to $6,000. Okay? So the limit is based on what your basis is, and your markup cannot exceed what your whole basis is in the property. We already talked about that. Okay, so for capital gain property, let's see, how do I talk about that? So just normally, capital gain property that doesn't fall into that previous exception that we talked about. So basically, if you have a piece of property that's subject to that depreciation recapture that we talked about, then that fit into the stuff that we talked about right here, right? Because that is property with depreciation recapture. So that's considered ordinary income property. If you have capital gain property that is not subject to depreciation recapture, your book really likes to use the example of undeveloped land. Okay? So if you have a situation like that, generally the deduction is the fair market value of the property. Okay, so you're not limited to that fair market value less short-term capital gain that we talked about there. You can use the whole fair market value of the property. Okay, the only exception to that is if you're donating it, for instance. Let's think of an example here. If I own some land that has a basis to me is $50,000, fair market value is $100,000, and I decide to donate that land to the Salvation Army. Okay, what's the Salvation Army's purpose or mission? Who do they try to help? Homeless people, poor people, needy people like that, right? So obviously, really any type of charity, not in the business of just trying to generate and make money, right? They're definitely not in the real estate business. So if I give this land to the Salvation Army, fair market value is $100,000, I decide I'm going to deduct, my charitable deduction is going to be $100,000 because it fits within this category. It's not recapture property. I should be able to deduct the full amount. But if the Salvation Army then turns around and instead of using that property to advance their mission, they just go out and sell it and make the profit and pocket the money, then I don't get to use that full amount. Okay? Then it basically kicks me back down to having to take the basis instead of the fair market value. Okay? So anytime, that can be a little bit tricky because you may not know at the time you donate to the Salvation Army what their plans are to do with the land. They may say, yes, we're going to take that land and we're going to build a Salvation Army warehouse on it, and that's going to store all the clothing and stuff, donations we receive throughout the year, and then we're going to distribute from there. But then, a month later, they decide, well, we changed our minds, we're going to sell that property instead. Okay? All of a sudden, you may have to the best of your knowledge, complied, but now your deduction may have been greatly overstated based on what they ended up doing with the property. Okay. So that one can be a little bit tricky. And as if you were audited and the IRS came to find out that that's what happened, of course they would still want their money, and of course you would still be subject to penalties if you didn't pay on time or whatever, but you wouldn't be liable for basically fraudulent return. I mean, they would look at that and realize, hey, it was a genuine mistake, but even with genuine mistakes, generally the IRS comes looking for their money. Okay, so example. Taxpayer contributes a forklift to the Salvation Army for use in the warehouse. Forklift has an original cost of $10,000, and $4,000 of depreciation has been taken. Fair market value of the equipment is $9,000. How much can the taxpayer deduct in that situation? What do you guys think? Only basically 3 answer choices here based on each of the 3 items that are listed as money right there. So take your pick. How much? 9,000. Yes. Fair market value of the equipment. Why? Anybody? Yeah? Got your hand raised? Careful with those. If we're donating equipment to the Salvation Army, what would cause it to be the $4,000 instead of the $9,000? Can you tell me that? When would you be, or no, it wouldn't be $4,000, it would be $6,000. Yeah, I mean, if it was considered inventory, but then you might, Salvation Army is probably considered needy, so you'd probably be entitled to half of the difference between fair market value and markup. Let's see. Yeah, that'd be pretty much the only scenario, but that's not the case here. Let's look at the next one. Okay, the taxpayer is a retailer and donates $1,000 or 1,000 blankets to the Red Cross for use in the disaster relief area. Blankets retail for $20 each, but at a cost of $5 each. What is the amount of the charitable deduction? The fact that the taxpayer is a retailer tells us that these blankets are inventory to them. Okay? So how much does this retailer get to claim as a deduction? $10 per blanket, right? So that would be $10,000. Why?
Because, as she was hinting, there is a half, but it's only about 100% of the basis, so you've only been reviewed 5 for each blanket.
Exactly. So who was that? Was that Gabby that said the other one? So that one would have been right if you didn't have to bump them back down based on 100% of what the basis was. Okay? So normally you would just look at half of what the markup is, but in this case, that half of the markup is limited by the fact that the original basis is $5. So the most that you'll be allowed to mark it up is another $5 per blanket. Okay, next question. ABC Corporation has a tract of land that it acquired many years ago with the intention of building a warehouse on it. Now the taxpayer has no use for the land in the near future. ABC contributes the land to the YMCA for the site of their new location. The original cost of the land was $50,000 and its fair market value is $125,000. What is a charitable deduction? This is that raw land we were talking about, undeveloped land. So what was the rule on that? Fair market value or basis? Say again? It has been held for 1 year. But this wouldn't have fallen into the ordinary income category anyway because it's not subject to recapture. Okay, so this was the last category we talked about where there's undeveloped land, and there's some scenarios where it's the fair market value, but an exception exists if the charity uses it for some purpose other than their charitable purpose, right? So in this scenario, we really don't have enough information to know for sure because we don't know what the YMCA, whether they're actually going to put their new location. Okay? But as of right now, we would assume that they're going to be doing what they said they're going to do with it, and we'd be able to use the full fair market value as our deduction. If it then came out that instead of selling it, they flipped it and made a nice little profit on it, then we'd have to go back in and use our basis, which was assuming no basis change, it would have just been $50,000. Okay. This is kind of just a review of what we talked about here. Limit is 10% of adjusted taxable income. This is talking about charitable deductions again. Adjusted taxable income is taxable income without any of those items, charitable contribution deduction, net operating loss carryback, capital loss carryback, dividends received deduction, or U.S. PAD. That note there at the bottom is important to remember, though, that any net operating loss carried forwards would be included in that. So why do you think they would include carry forwards but not carry backs on the same type of income? Anybody have any idea? This is one of the times that the IRS is actually being a little bit friendly to taxpayers. But basically the idea is if you are using something that happens in the future as a way of determining what today's deduction would be, then you're inviting all sorts of amended tax returns in the future. Because what would happen is basically, right now I would file it one way, and then 3 years from now or 2 years from now, when all of a sudden I have a net operating loss that I can carry back, I would have to take that net operating loss, carry it back to this current year that I'm in now. That would change my deduction for the charitable contribution, but then it would also change any other deductions that included the charitable contribution. So it'd basically be a domino of changing items that, I could have to change multiple times. If I have a net operating loss carryback next year, and then the following year, and then the year after that, I could feasibly have to change all of these items. And when you get down to number 5 there, that may end up having been changed like 15 different times over the course of this time period. So it doesn't make sense to use future items to calculate current deductions. But carry forwards, you already know about going into this year, so it makes more sense that you can use a net operating loss carryover or carry forward in calculating this year's deductions. Again, any contributions greater than 10% can be carried forward for the next 5 years. After the 5-year carryover period, it just disappears, basically. And in terms of that 10% threshold, any carry forward from previous years counts towards this year's 10% threshold. So if I'm carrying forward, $50,000 worth of charitable contributions, and then next year, for next year by itself, I have $20,000 of charitable contributions, that ends up being 8% of my adjusted taxable income, then I would have a very small portion of that $50,000 carryover that I would be able to use for next year's charitable contribution deduction. And I would have to carry over the remainder of that $50,000 deduction into future years. And what that basically means is I can't take and use all of my carryover first so that I can preserve it and then carry over a newer deduction into future years. Because you'd have tax incentives to use the oldest money first, the oldest deduction first, because that's going to expire faster. Okay? The IRS wants you to use current money first, or current deductions first. That way, they can basically force you to have your older contribution deductions expire at the end of that 5-year period. I know this can get convoluted and confusing, so bear with me. Okay, so now we have these special deductions. We've got the U.S. production activities deduction, the dividends received deduction, the net operating losses, which that's not really all that different. And then we want to talk about the sequencing of those deductions. So for U.S. production activities deduction, there's the calculation there. Basically, you're taking, I think it's on the next slide. Yeah. So basically, you're taking qualified production activities that basically occurred within the United States. Whoops, not too far. And anything that fits into that category of the qualified production activities income, which is basically just money earned doing business within the United States, you can take 9% of that and use that as a deduction. So again, this is kind of an incentive to do business within the United States for U.S. companies. However, the 9% is used on either the lesser of your qualified domestic activities or your taxable income before the deduction happens. So basically, for the purposes of this deduction, you'll divide your income and expenses into items that qualify for the domestic treatment and items that don't qualify. Okay? You'll have your items that qualify, and you'll say, okay, I have $500,000 of qualified domestic income. And then I have another $100,000 of other income that doesn't qualify for that. So my taxable income is both of those combined, right? The amount that qualifies for the domestic treatment and the amount that doesn't. In this case, that would be $600,000. So I would take the lesser of the amount that qualified, or my total taxable income, multiply that times 9%. So in this case, that would be the $500,000 times 9%. Okay? The only time that that's really different is if you have your qualified domestic activities, and then on the other side, instead of having income, you have a loss for your activities that are not qualified domestic activities. So say you have $500,000 qualified domestic activities, and then a $100,000 loss for your non-U.S. activities. Then the lesser of those of taxable income or your qualified domestic income is actually going to be your taxable income. Because for domestic activities, you have $500,000 of income, and then you have a $100,000 loss in the other category, so your taxable income there is $400,000 instead of $500,000. Okay? I know that's a little bit complicated, but basically, just look at your domestic income, and if you had a loss outside of your domestic income, then you lower your domestic income by whatever that loss is and multiply the result times 9%. You're limited to 50% of your W-2 wages that are eligible to qualifying U.S. production activities. So basically, look at how much you paid out to U.S. workers working on these U.S. activities, and whatever that amount is, divide it in two, and that's your upper threshold limit on the U.S. production activity deduction. This is the calculation for qualified production activities income. Well, it's pretty simple. It's basically any income that you generated within the United States doing activities within the United States minus expenses that are attributable to earning that income. Let's see here. Okay, dividends received deduction. So basically, if you are a corporation that owns stock in another corporation, and that corporation issues a dividend to you. If there was no DRD, basically what would happen is you've got Corporation A that owns Corporation B stock. Corporation B declares a dividend. Okay? So the income coming into Corporation B is taxed at the corporate level. It's again taxed when the dividend goes to Corporation A. Okay? It's again taxed when that same money goes out to the shareholders of Corporation A. So it's essentially the same money is taxed 3 times before it gets to the end owner's hands. So to eliminate that triple taxation, you have these dividends received deductions. And they vary, as you see here, based on the amount of ownership that you have in that Corporation A owns of Corporation B stock. So if Corporation A owns less than 20% of Corporation B stock, then however much Corporation A received in dividends from Corporation B, you will be able to deduct 70% of those dividends from your taxable income. If it's between 20% and 80% of Corporation B stock that Corporation A owns, then you can deduct 80% of the dividend. And if you own 80% or more of Corporation B's stock, then we're basically saying you own Corporation B. There's no reason that you should have to pay any taxes on the dividends going from Corporation B to Corporation A, because 100% of those dividends will then have to filter through Corporation A before they go out to individual owners of Corporation A. Okay? So you're entitled to a 100% dividend in that, deduction in that case. Oops. Okay. I'm not going to get too much into affiliated groups. I'll show you a little kind of flow chart on determining whether an affiliated group exists. But basically, you can kind of treat an affiliated group the same way that you treat owning 80%, Corporation A owning 80% of Corporation B. A lot of the same rules apply. Let's see. I'm not going to get too much into the minutiae here, just in the interest of time. So unlike capital losses, the taxpayer can actually decide that they want to forego any carrybacks with respect to the dividends received deduction here. Where a corporation, let me see here. Would a corporation ever want to forego carrying money back into the past, carrying deductions back into the past? Conventional wisdom would say it makes sense to get the benefit of your deduction as soon as you can, because of the time value of money. If you have the money now, it's going to be worth more than if you have the money in 3 years. So why would you ever want to push your deduction off into the future instead of taking it either now or putting it back into the past? Anybody have any idea? Any business reason why you might want to do that? Well, the time value of money is fixed basically on essentially what the going interest rates are, right? There may be a greater difference between, for instance, what your tax rate is this year compared to your tax rate in 5 years. So if this year you're at a tax rate of, say, 20%, and in 5 years you anticipate growing to the point where your tax rate is going to be 35%, then the time value of money is less than the 15% difference in tax rate that would be from this year to that year. Okay? So if you anticipate these great changes in your tax rate, or if you anticipate having much more taxable income in the future, then it might make sense to push it off into the future. Or especially if, carrybacks, you have very little to no taxable income, and carry forward you expect to have lots of taxable income, then you're going to be looking for more and more deductions in the future. Okay. Let's see here. Sequencing these calculations, basically you start with any deductions that are not charitable, dividends received deduction, net operating loss, or U.S. production activities deduction, and take those off the top. Okay? Then you calculate your charitable contributions. Then you use that number, okay, below that, to calculate your dividends received deduction. Then you take below that to calculate your net operating loss carrybacks. Then below that, finally at the very end, to take your U.S. production activities deduction. Okay? And for instance, like U.S. production activities deduction, if you don't have anything to deduct, it's over. It's done. You don't get to carry that backwards and forwards. So obviously, taking these in the right order will greatly influence the final amount of deductions that you have at the end of the year. So just talking about in general, once you determine that you have a controlled group of corporations, if you are transacting between those corporations and you're buying and selling, you essentially can't recognize any losses on sales to another member of the controlled group when that sale occurs. You have to wait until whatever assets you're transferring leaves the hands of a member of the controlled group, at which point the controlled group, whichever member was the last to hold that asset before it went out of the hands of the controlled group, that member will be able to take advantage of any deferred losses. Testing for controlled groups. The statute says testing occurs the last day of the year, but in actual practice what happens, because there's, and I don't know, this is a stupid law writing here, but what actually happens is they look at how long you were a member of the controlled group for the year. If you were a member for greater than half the year, you're considered to be part of the controlled group for that year. If it was for less than half the year, you're not. Okay? So this is a flowchart example of a parent subsidiary controlled group. This is when, obviously, you see there, you have a parent corporation, and let me get my marker here. So right here, the parent corporation controls Axle Corporation, right? Neither the parent nor Axle Corporation on its own controls Wheel Corporation. They both have a 40% ownership rate there. But if you take 40% plus 40%, then parent and Axle together control Wheel Corporation. So this is an example of a controlled group. Okay? Based on, you're basically taking this 40% that Axle owns and attributing that back to the parent corporation because the parent corporation owns 80% of Axle. Okay? So that basically means that Wheel Corporation essentially is treated as if parent corporation by itself owns 80% of that one as well. We didn't talk about this in the lecture today, but it talks about it in your book a little bit. These are called brother-sister controlled groups. The stipulations here is for a brother-sister control group, between the brother and sister, so you got Walt, I can't read this person's name here, Gail. Between the two of them, they both own all of North Corporation and South Corporation. Neither one of them owns 80% of the other one, of the other corporation, of either corporation, right? But they have in common, essentially, I can't remember the exact verbiage of how that is. Let me see if I have that here. I think it's called community ownership, if I remember how the book talks about it. But basically what it's saying is, as long as between Walt and Gail, if what they own in common of both corporations is at least 50%, and together they own at least 100%, or if together they own 100% of each corporation, then both of these are in a controlled group. And the way that's calculated is this. You look at what Walt owns of North Corporation, 30%. Okay? Gail owns 70% of North Corporation. So the amount that they have in common ownership of North Corporation is basically the lesser of those two. So in common, they have 30% of North Corporation each. What's 30% times 2? 60%. Okay? So they meet the 50% threshold rate for North Corporation based on that 30 plus 30%. Same thing for South Corporation. Walt owns 70%, Gail owns 30%. So what they own in common there is the lesser of 30 or 70%. They both own at least 30% of South Corporation. And when you add that commonality together, it's greater than 50%. I know it's really confusing. So if you didn't follow that, don't worry. These don't happen all that often. We're not going to talk about them all that often. Let's see here. I don't really want to get into the nuances of this flow on this one either. Let's see. Consolidated returns we'll talk about more later on. But basically, to qualify to do a consolidated return, the parent must own 80% voting and value of at least one other corporation, and the group together must own 80% of stock, voting, and value. What that means is 80% of the voting stock and 80% of the total value of stock that the corporation is issued. And all of those don't qualify to do consolidated returns. Running out of time here, but see how much I want to talk about these. This is basically just kind of housekeeping rule that the IRS saw at one point that corporations were essentially acquiring other corporations to only take advantage of some of the tax characteristics that the other corporation had. So a corporation that has a lot of earned income may go out and acquire a corporation that has a great big loss for the year just so that it can use that operating loss to cancel out the income of the original corporation. Okay, so sometimes from a bottom line perspective, buying this company that's doing poorly actually saves you money because you get to save all of that tax money by using the loss of the one company to offset the gains in the other company. The IRS basically said, you're not allowed to do that. Okay? You cannot acquire another corporation solely to use any outstanding net operating losses. And we'll talk about that more as it says there in Chapter 7 and 8. All I really want to talk about as far as estimated taxes go is corporations must pay estimated taxes. And it's not sufficient to just look at last year's corporate income tax, divide that into 4 pieces, and say this is what we're going to pay this year. Okay? You have to take a little bit more due diligence, especially if you're a corporation that has grown significantly this year. Obviously, if you've doubled your income this year, the IRS is not going to say, we're okay with you just taking last year's income and using that to figure the estimated tax you have to pay throughout the year. Because basically for corporations, you have to estimate what your tax is going to be for the year and pay that amount, a fourth of that, quarterly, so that basically the reason behind that is so that the IRS can take advantage of the interest earning power there instead of the corporation. But it's also to safeguard the IRS in the case of a business going bankrupt mid-year so that they can have collected tax payments throughout the year. Okay? The other issue there is that you also have to account for alternative minimum tax. So if in the previous years or in this year there's red flags that say, hey, we believe we're going to be subject to alternative minimum tax this year, those must be part of your calculation when you're looking at what the estimated tax for this year should be. There's penalties for underpayment of estimated tax. I'm not too worried about you knowing exactly what the penalties are. Just know that they're there, and if you need to find how much they are, you can look them up. And then the last couple slides, I'm not really going to look at the slides too much, but I just want to go over the concept of book tax differences. So obviously, there are many instances where the values that you have on your books differ from the values that you report for tax purposes. Some of those differences are permanent, some of those differences are temporary and will be resolved as the years go by. Okay? So, for instance, if it's just a matter of under tax law, they require you to recognize income this year, and under your financial accounting rules, you're required to recognize that income next year, then obviously that difference will even out as time passes. Because instead of, on the one you recognize it this year, on the other you recognize it next year, but either way, by the end of next year, you've recognized all of that income that was different. Okay? And then there are other permanent differences, like if you are getting interest on municipal bonds, okay, that's tax-free interest. So in terms of tax liability, you don't report that as income. But obviously on your financial books, any income that you get is reported as income. So, and that's never going to change. Okay? It's not like you are just deferring that tax liability. You never have to pay taxes on that income. So there are some differences that are temporary, some differences that are permanent. Basically, you almost have to keep track of two separate sets of books. One for tax purposes, one for financial accounting purposes. And then every time that you close the books and do financial statements, you're basically required, or do taxes, to not only have separate sets of books, but also a document that reconciles the differences and says, look, total income here on taxes is different to total income on my books because of X, Y, and Z. Some of those are temporary, some of those are permanent. These ones are temporary and they'll resolve themselves later. These ones are permanent and will be differences for the life of the company. Okay? Any questions on any of that? The final slide was on, I do want to say one thing on that. Uncertain tax positions. Okay? Uncertain tax positions are a category of difference that could be a temporary difference between financial accounting and tax accounting. But basically, for financial accounting purposes, if there's a 50% or less chance that the IRS is going to accept whatever tax position that you've taken, in other words, you're not sure about how to file a tax, or there's some vagueness in taking some deduction that you take. And you can argue that the IRS should allow you to take that deduction. The IRS might have an argument that you shouldn't be allowed to take that deduction. Okay? If the chance of you succeeding on taking that deduction is greater than 50%, then you can account it that way on your books. If it's less than 50%, then you're not allowed on your financial statements to calculate your income tax that way. So on your actual taxes, you could pay one amount in income tax, and on your accounting statements, you actually have to record it as having paid a different amount, because this is something that you would disclose in the notes to your financial statements, but because you have that rule of not wanting to overestimate your income or underestimate your liabilities, So you have to assume if it's less than 50% chance of happening that you're not going to be able to succeed on that deduction. Okay, that's the last slide. Anybody have any questions on any of this stuff? I know this chapter is especially illustrative of some of the complications that arise in corporate tax versus individual tax. And it just gets more complicated the deeper you go into the nuances. So don't worry too much if you didn't understand all of that. Do your best to understand. I'll try to post some example problems of some of the more difficult concepts, probably mainly working through the order of taking those deductions, maybe a comprehensive problem that looks at taking all of those deductions for a certain year. If you have any questions before you take the quiz, let me know. Otherwise, I will see you all next week.